but we've seen this before. We know what comes next. It is time to hang on tight, be smart, be calm, be collected, and understand that the end game is just around the corner. Well, hello there, my friends. Rafi here from the End Game Investor with this week's Silver Report for Arcadia Economics. And boy, are we deep in it now. We are deep in the final liquidity crunch. We are deep in the final chase of price inflation. We are deep in the price inflationary cycle, and we are very close to the final Fed pivot. It could be weeks, it could be months, but it is going to be soon. And I will say with confidence that the next round of money printing is not going to reinflate asset prices. It is only going to pour into consumer prices and into gold and especially silver. How do I know that's going to happen? Mathematically speaking. This isn't a guess. It is a logical necessity, and I will explain to you exactly what I'm talking about in this slideshow ahead. For now, just keep in mind that these are the times that separate the silver men from the silver boys. And I use gender-specific terminology. And the first thing I'm going to show you today is a chart that I'm guessing you've never seen before. This silver report is brought to you by Fortuna Silver Mines. Fortuna is at a bear market bottom low of 2015 levels, late 2015, early 2016, when gold and silver both bottomed. Let's face it, if you can't buy the gold stocks at these levels, you never will be able to. And it's about buying low, selling high. The latest from Fortuna is from July 11th, just a few days ago. They reported gold production of 62,171 ounces, a 100% increase over the last quarter. This does not include the new mine in Ivory Coast, which is scheduled to begin production next year. This company is hedged against production costs, meaning their costs are not rising significantly. So now is the time to get the best deal on this company. Could it go lower? Anything could go lower. We saw oil go negative in 2020. So we are at extreme situations now. This is the time to buy low. Am I making a recommendation? No, but this is a responsible company that will survive this time period. And that I'm pretty sure of. This comes from Mermacan Capital's latest research paper that was released yesterday, July 13th, and it shows two lines. One of them is an exponential growth curve. And you see here the smooth curve, the light blue line, beginning in 1960, with overlaid the assets or the liabilities of the Federal Reserve, meaning the Fed's balance sheet. Now you see here how the Fed's balance sheet has to always catch up with the exponential growth curve. And right now we are already just about in the vertical stage here. Well, we see here that the Federal Reserve's liabilities or assets, interchangeable, travel off of the exponential growth curve here. And all of a sudden they have to compensate by jumping up in 2008, which is the financial crisis, obviously. And we bounce along the exponential growth curve here. And then here is quantitative tightening, the end of QE3 and the fall in the Fed's balance sheet. And right here is the apocalypse of September 2019. And as coincidence would have it, all of the COVID money printing got us right back onto the exponential growth curve. And right now we see here this tiny little dot. That is the end of quantitative easing, or the latest quantitative easing, QE. And we are about to travel off of the exponential growth curve again. How long will that last? Not very long, and we're going to have to see another vertical spike in money printing, or everything is going to go bankrupt. And why is that? Very simply because debt grows and grows and grows, and the monetary base, the amount of dollars available to service that debt, is no longer growing. And so therefore overall leverage gets higher and higher and higher, and the bids for the remaining dollars go higher and higher, and everything is sold to get those dollars so you can keep servicing your debts, which includes gold and silver, which is what is happening now. However, only one of two things is going to happen from here. Either the central banks of the world, led by the Fed, are going to rescue the monetary system, the global monetary system, by printing a whole bunch more money, which they cannot stop doing. And gold and silver, especially silver, will explode, and silver will head to the 15-to-1 ratio of its monetary nature. or the Fed and the central banks of the world will give up. And there will be a rush to gold and silver anyway as panic sweeps the globe. Let's take it from Daniel Oliver of Mermicane Capital, the author of that chart I just showed you. He is one of the very few monetary analysts that I really look up to, and his words should be considered very carefully. Now, I talked about those two possibilities. Either the Fed prints or it doesn't print. Let's go over both those possibilities. Says Oliver, as a form of collateral, and this is what's happening now, gold and silver obviously gets sold to meet margin calls along with gold mining investments. So you have all these people with a bunch of debt that don't have enough dollars, and so they sell assets or they sell short other assets in order to get dollars because that's what they need to stay in business. That is the crunch. That is what is happening now. We are now seeing the familiar pattern. It continues playing out again. Costs are increasing. Operating margins are tightening. Gold and silver and the miners are being sold off as the world heads into the next liquidity crunch. We know what comes next. The Fed must print, and gold miners and silver miners obviously will respond first and fastest, just as they did last time. And he adds, what if the Fed does not print? The chances of that are very small, but let's just take the possibility. Then the solvency of the Fed itself and the banks and the government come into question, and gold and silver price projections of $10,000 an ounce and a 51 ratio that would be about $500 an ounce become conservative. How is it that the solvency of the Fed itself comes into question? Because if the Fed does not print money to have debtors service their U.S. treasuries or mortgage-backed securities, and the value of those securities becomes zero, and the balance sheet becomes impaired, and therefore the unit of liability on that balance sheet, which is the dollar itself, dies. So if the Fed goes bankrupt, the dollar loses all value, and therefore they must print. They have no choice. Here's what really flirted me at Daniel Oliver's latest research note from yesterday. He agrees with me about the timing. It is coming up in the next few months. And how do we know this? He says, when the world loses confidence in the Western banking system, perhaps as soon as this winter, when Europe will face economic and political collapse because of the conflict with Russia, the Fed will be forced to print more and faster, and there will be runs on central banks. There are no liquid assets on these balance sheets that can be sold to support the currency. We know that Russia has just cut Germany off from its main gas line, and they say it's maintenance and they're going to put it back on in about 8 days from now. But we all know that they won't. This is Russia basically pulling the same trick it did on Napoleon and Hitler, scorched earth policy, cutting off the Europeans from all natural resources. However they do it, it's different technologically now. It's through a pipeline instead of actually burning their cities. But effectively, it's the same thing. This is scorched earth. Napoleon failed. Hitler failed. Germany and the rest of Europe will fail in strangling Russia. They're going to try. Call it what you will, valiant, not valiant. I'm not commenting on the politics here. I'm just explaining what's going on. But Europe is teetering, and it will fall. And then the dollar will be alone among fiat currencies until the banking system in the US also starts to teeter, and the final printing round will begin. The slingshot is going to be spectacular. You just got to understand the business cycle and get through it. It's coming. If we go into some little bit of technicals here, we have junk premiums, junk silver premiums now pushing 27%, pretty much where they were at bear market bottom 2015 in November, December 2015. That was the record barring financial crisis. Obviously, 2020 was a monetary crisis from the COVID era, and 2008, obviously, the financial crisis then. We are now at levels of bear market bottom, and we still have a financial crisis ahead of us. Where our premium is going to go, they're going to go damn high. And on the delivery front, we have a continual drain in COMEX supplies. We are down to 62.7 million ounces, where the red line I drew over here. This is now, it looks like to be a 60% fall from the post-silver squeeze one highs. Silver is draining from the COMEX. People are taking advantage of the spectacular low spot price at these prices. We can expect the drain to continue. There's about 12,540 contracts worth of silver left for delivery, and it will keep falling in the weeks and months ahead. Now, we just had a major CPI report released, and we all know the headline 9.1%. Food inflation is even higher. I think it's around 12%. Food at home, I think, is even above that at 13%. But here's the chart I wanted to show you today. Sticky price inflation. The Atlanta Fed divides sticky prices with flexible prices. Sticky prices are obviously prices that don't change as often as flexible prices. And we have the sticky prices going on a slope that is steeper than at any time since 1970. Price inflation has not peaked, and at these levels, we're going to start seeing some panic with people buying consumer goods that they don't necessarily need now, they need later, but they're going to buy now in order to get in front of the price inflation. I saw this article in Bloomberg with a quote from Raphael Bostic of the Atlanta Fed, followed by what I believe is a crazy admission by Bloomberg, and it is this. Everything is in play, Atlanta Fed President Raphael Bostic told reporters in Florida. Asked if that included raising rates by a full percentage point, he replied, it would mean everything. So yes, a 100 basis point hike is on the table. Will it be enough? No. Now, this is the paragraph that floored me in Bloomberg. The comments added fuel to bets that the Fed is more likely than not to raise interest rates by 100 basis points when it meets July 26th to the 27th, which would be the largest increase since the Fed started directly using overnight interest rates to conduct monetary policy in the early 1990s. It's that final sentence that really floored me. Why? Because this is an admission that the Fed didn't always use to tweak interest rates to conduct monetary policy. That is not how they did it in the 80s. That is not how Volcker did it. Volcker targeted the money supply, and he tweaked interest rates in order to target the money supply, which was the center of his monetary policy. Only since the 1990s has the target rate been the interest rate itself rather than a tool to control the money supply. Obviously, if you want to control price inflation or inflation itself, you want to target the money supply. You don't want to target interest rates and leave the money supply to its own devices. That doesn't make any sense. And here, Bloomberg admits that this whole experiment by conducting monetary policy through interest rate targeting rather than money supply targeting is a new thing that was only introduced in the 1990s. So maybe they're going to have to turn around and try to target money supply, but they can't do that either. The final point I want to make here is that the next printing round is coming, but it will not save asset prices. And I told you at the beginning of this video, I would explain to you exactly how I know that. First point, in order for money printing to stimulate the economy, meaning to raise asset prices, which people think means stimulating the economy, the money needs to be loaned out by the banks. Step two, loaning it out at interest rates below the inflation rate makes no sense. Why would a bank loan out funds at, let's say, 3% or even 4%? Let's say the Fed raised interest rates by 200 basis points, 300 basis points at the end of July. And then we have interest rates, let's say 4 or 5%. Why would they loan funds out at 4 or 5% when the consumer price inflation rate is near 10%? It doesn't make any sense. So there is no reason for them to loan funds out, and therefore new money cannot go into asset prices. Where is it going? It is going into reverse repos. So my point 3, unless the Fed hikes overnight rates 1,000 basis points and only then prints money, new money should only blast into still more reverse repos. Finally, what will the new printing round accomplish? It will destroy any remaining confidence in the currency. So there is a reason that reverse repos, that money printed during the COVID era, is still stuck at the Federal Reserve in something called reverse repos. That is when extra cash cannot be loaned out, so it is loaned right back to the Federal Reserve at interest. It is now at about $2.2 trillion and it has not fallen. That means there is nowhere else for all this money to go to. Why? Because it cannot be loaned out at rates above the rate of inflation. And that is not going to change because the Fed is not going to hike 1,000 basis points at the end of the month. And therefore, the new printing round will come, but it will not stimulate asset prices. Instead, it will stimulate consumer prices. And at that point, the world will understand that the dollar's goose is cooked. No matter how well it is performing against the euro or the dollar index, or no matter where it is, it doesn't make a difference. The question you want to ask yourself over and over is, when the purchasing power for consumers of the dollar collapses, what asset are people going to chase? Banks are going to chase gold. They've done it for hundreds of years, for every financial crisis that has ever existed since Gold became money 5,000 years ago. What asset is the public going to chase when they realize that the dollar can no longer buy anything that they need? It's primarily going to be silver. And as that happens, the ratio will fall to 15-1. It is hard to see that now, especially with the price action, but we've seen this before. We know what comes next. It is time to hang on tight, be smart, be calm, be collected, and understand that the end game is just around the corner. This is Rafi of the Endgame Investor coming at you with this week's silver report for Arcadia Economics. I genuinely do not know how many more of these I'm going to make until the dollar collapses, but I have a feeling it's not going to be that many more.